welcome everybody to this presentation, and today I'm going to be discussing the solo 401k retirement plan, which is also known as ultimate retirement plan. And it's a great topic that is of interest of many, and I hope you guys will enjoy it. Just a quick information about myself, and before I do that, just a quick disclaimer. Sense Financial Services is not a fiduciary. We do not provide legal, tax, investment, or accounting, or any other professional advice. My specialty is in retirement accounts, and that's what I'm going to be talking mainly, but I'll be throwing in some bits and pieces and other things that I'm aware of and learn, but again, I don't provide the professional advice, and if you do need that kind of advice, we always recommend that you seek expert help to help you. So you can see my contact information here on the screen. I will show that at the end as well. But I always welcome any questions from you folks, and we do offer a free consultation as always, and you're welcome to contact me directly or call the office, and we can schedule a free consultation for you guys. Because what we found is that typically in a group presentation, whether it's a live or a webinar like today, it's pretty hard to address every single situation there, and every single situation and person is unique. So that's why it just makes sense for us to talk about your specifics, where I can learn more about what your goals are, what your situation is, and then that will enable me to give you the best advice, best recommendation based on your situation. And just a little bit about myself. This is my beautiful family, my wife and our 8-year-old daughter, and this is the reason why I do what I do. And the reason I'm showing this picture to you is because each and every one of you should have a similar reason, and you should keep that picture or that reason in front of you, because that will help you keep you motivated and to do what you need to do to accomplish the goals that you have. And since we're talking about retirement accounts today, this is an important topic that pretty much everyone is involved in that. So it's very important that you set proper goals and keep them in front of you. Now, just a little bit about the background and the history of our company. The name of our company is Sense Financial Services, and the reason behind this name is because the financial concepts that we teach, they just make sense. And they're based on proven biblical principles of financial planning and investments. And our tagline here, or motto, is wise financial stewardship. And Proverbs 21:5 says that good planning and hard work leads to prosperity. And I know this may, for some of you, be a topic that is new. Maybe you never spend time investing in learning about retirement planning, but guess what? If you give control to your savings, to your retirement dollars, to somebody else, and if everything fails at the end, who are you to blame? So you need to take the responsibility into your own hands, and you need to invest the time to learn and how to manage your retirement account and your investments. And when it comes to retirement accounts, our goal is to help our clients obtain control over and protect the retirement accounts. And another quote from Proverbs here, Proverbs 21:20 says that the wise man saves for the future, but the foolish man spends wherever he gets. And unfortunately, there is very many foolish people out there that just live in a paycheck to paycheck, and they don't do any planning for the future. But it's just a wise thing to do, to set aside some time to talk about this, to learn this topic, and also to then start putting money away. And many of you do have retirement accounts, and I commend you for being here on this webinar to invest the time to learn how to be better stewards of the finances that you have. Now, let's talk about the options. When it comes to retirement accounts and the options that we implement is you basically have two options. Number one is the self-directed IRA, and number two is a self-directed solo 401k that gives you the checkbook control over your retirement account. It's also known as Ultimate Retirement Plan, and we're going to talk about both of them. We're going to kind of switch between one and the other, and we will compare the two, and to help you understand the benefits and make better decision. So what is a self-directed IRA? A self-directed IRA is a tax-deferred trust account that is placed with the IRS approved custodian, such as a bank or a trust company. When it comes to self-directed retirement accounts, you're dealing with the trust company, unlike just the main custodians like Fidelity and Schwab, where they have limitations on investment options. A self-directed custodian does not place those limitations. So the main benefit of self-directed IRA is that it allows you to invest into non-traditional assets. The reason that majority of people out there not aware of existence self-directed IRA and 401k is because your financial advisor and a stockbroker are not interested in you learning about this option, because they want to keep you invested in the stock market. That's how they make money. I've been in this industry myself, and I left this industry for this reason, because I just wasn't comfortable making recommendations to my clients about investments that I could not control myself, and my clients couldn't control, the stock market. Unfortunately, there is very little control you have. You can employ some practices and some tricks to maybe minimize the losses, but ultimately, you and we have very little control over that. But self-directed retirement accounts been around for quite some time, actually been created by the federal law in 1974. So when people ask me sometimes after hearing me present, is that something new? No, it is not new. It's been around for some time, but just, you don't hear it advertised on the TV, and your financial advisor is probably not going to talk to you about this, but think about this. Just think about this, what I'm about to tell you. When you have your money managed by some stockbroker or financial advisor, and regardless of the performance of your portfolio, whether it's going up or down, if your financial advisor makes money off of you regardless, think of it. Does it make sense? To me, it doesn't make any sense. If it doesn't give any incentive to your advisor to do a better job managing or investing your money, it just doesn't make sense. So if you're employing someone to help you, be sure that you're using a fee-only advisor and not somebody who simply sells you some mutual funds or some stocks and makes the percentage off of the assets under management. It's just not a good situation there. But self-directed retirement accounts been designed to help people like you and I save money for the retirement. They've been designed under Internal Revenue Code Section 408. Now, as I'm going through the presentation, and please take notes, and if you have any questions, just jot them down, or you can actually type them in a chat window so we can address them later for you. So be sure to just either ask them at the end or just type them in the chat window so we can see them and we can answer them for you towards the end of the presentation. So just a quick comparison between conventional retirement accounts and self-directed retirement accounts. So when you have a conventional IRA and 401k, and most of you on the call probably have some type of retirement account, The problem with that is that your retirement account investment options are limited. They're limited to stocks, bonds, and mutual funds, and they're limited by the custodian. So custodian is the problem. Your current custodian dictates what you can and cannot do within your retirement account. And here is an example for you of just an overview of the investment options. And I remember when I was working at my last job and we had a 401k there at the company, a representative from the company will come up to us and meet with all the participants of the 401k about once a year and will give us similar option as you can see on your screen. So as you can see, just a very, very limited investment options. Now, if you have an IRA, you probably have maybe a little bit more options. You can pick a little bit more, maybe I can have access to more mutual funds, but the bottom line is that it just confined to equities. You know, your investments are confined to just those of a stock market. And if you think that your investments might be diversified when you invest in a stock market or in mutual funds, while it may be diversified within a mutual fund between different equities, but it's still it's just one asset class. So to achieve a true diversification, you need to do something else. So a self-directed retirement account has virtually limitless investment options. And here on the right side of the screen, you'll see just a few examples here of the most common investments that I see my clients make. Probably most common is real estate. Then you'll have tax liens and trust deeds. You can invest in real estate options. You can use your retirement dollars and actually invest in mortgage notes and trust deeds. You can be the bank. You can invest in businesses and partnerships. You can buy real estate out of the U.S. I have clients who buy in real estate in South America, in Canada, in India, and just recently I had a client who's buying in Japan. So you do have those options. Within self-directed retirement accounts, you can invest in something that you understand the best and have more control over. And that's the key. You know, you shouldn't be investing in something that you have very little control. Invest in something that you understand and can control. And last note here is that this is a misconception that sometimes I do see. People think that once you set up a self-directed IRA or 401k, you can only invest in real estate. No, that's not the case. You can still do the same conventional investments like stocks and mutual funds within a self-directed IRA or 401k. So if you're looking at your account statements, you might be thinking something like this. This is a cartoon that my daughter actually drew for me for this presentation, and the man says, after looking at his retirement account statement, he says, I finally decided to put something aside for our retirement, our plans to retire. So if you felt that way, there is a hope for you, and there is some options for you. Now, let me give you an example of one of our clients. You know, I think it's going to set the stage for us. This is Jason. Jason actually lives in Florida, and he contacted us. He found us over on the web, over the internet, and he called us up. I actually spoke with him myself. And before coming to us, he had this situation. He had a couple different retirement accounts, an IRA and 401k, valued about $135,000. He actually was watching, just like in I mentioned before, like some of you, he's been watching his statements and looking at his balance just going down. So he was really concerned about that, and he got fed up. He got just frustrated, and he eventually liquidated all of his investments and just kept money in cash. Now, guess what? If you think that your money is safe, not invested anywhere, just keep it in a money market or a savings account, it's not. Your money is losing it's purchasing power to inflation, because what money market account pay or savings account pay? 0.5%, if that, and the inflation is 3, 4, 5%. So you need to make sure that you invest in your assets wisely. So he contacted us, and we had a consultation, and we set up a self-directed 401k for Jason. He was a self-employed individual and qualified for a solo 401k. And here is what we did for him. He used his retirement savings, and he invested his 401k into property. He purchased a property, so now his 401k owns this rental house. It's titled in the name of the 401k. Jason controls that, but all of the income from that property every single month going back into his 401k. So guess what? His 401k account is growing every single month comparing to before, right? And now, then he had some money that he invested with his brother. His brother started manufacturing business, and he did start successfully several businesses prior to that. So he invested with his brother. And then money that is left over, he actually invested in a real estate note. So he used his 401k as a bank. And his 401k became a bank. He lent money to somebody else. Somebody else owns the property. He doesn't actually doesn't have to deal with the tenants on this particular property. He just collects his payments. His investment is secured by real property. It's a guaranteed return and pretty low risk. So he's getting about $1,000 a month every month. So think of this and compare what we had before with what he has now. And again, it's just one example. You know, there's many examples like that, and you can diversify as much here. It just think about this and what you have and what you can do with a self-directed retirement account. Increased interest in these types of plans was as a result of the change in the tax law in 2002 that made all of the benefits that I'm about to share with you possible. And they're pretty amazing. They're pretty amazing. So while this plan is not new, but the way it is, it's fairly new, and still there's many people that are not aware of its existence. So let's jump and let's talk about the benefits of the solo 401k. But actually, before we do that, let's talk about the eligibility. So to be eligible for a solo 401k, there are two criteria that you need to meet. Number one, you need to have a presence of some sort of self-employment activity. And that self-employment activity can be in any type, shape, or form. You know, and I just threw a list here just to give you an example, to give you a flavor. It can be anything. You know, you can be a doctor, and you can be actually a doctor working for a hospital or somewhere else as a W-2, but you can also have some additional contracts. So if you receive that 1099 income, there you have it. You qualify. You can be an attorney, you can be a property manager, even if you manage your own properties. You know, if you, many investors, I find they manage their own properties, so they can set up a property management company, and that will qualify them. You can be, I know some people, they just get involved in those just so that they can use the products. You know, they maybe not really driven out there and building a huge businesses, but they're just part of the network marketing business because they like the products or services. You can be an IT consultant. That's an example of one of my clients who is in IT business, works for a company, secure job, but he has some accounts on the side that he services a couple of clients. You can be a nurse. If you receive a 1099 income, you qualify. You can flip properties. You can do wholesale deals. If you're doing a trade, then you can qualify as well. If you turn into that into a business, you can be a contractor, independent consultant, and just the list goes on and on and on. So as long as you have, you can show some kind of self-employment income that is subject to self-employment tax reported on Schedule C, you qualify. And second one is absence of full-time employees. If you have a business and if you don't have full-time employees, and IRS definition is 1,000 hours or more, then it's considered full-time. Then, so if you have those two, you qualify for a solo 401k. So the bottom line is that if you have a business with full-time employees, that's pretty much the only thing that will disqualify you from participating in this plan. Because if you don't have a self-employment activity now, it can be started pretty easily. Now, the reason I'm spending time on this and explaining this to you, because if you're thinking, well, I don't qualify, I don't meet that criteria, this is probably not for me. Well, don't tune out yet. You know, just continue listening and learning. And I had a number of clients who started self-employment activity or some sort of business just so that they can qualify for a solo 401k, because the benefits that it offers is just amazing. All right, so let's spend a little bit of time on talking about the second criteria, absence of full-time employees. So as I mentioned, the plan is designed for self-employed individuals or small business owners without full-time employees other than business owner and the spouse. Now, if you have a business and you lease employees, basically you may have employees that they don't work for you directly, they might work for some other company or agencies, but they do, you know, work for you. They come to your office and they clock in and out. They're considered leased employees, and for the purposes of the 401k, they will be considered employees. So that will disqualify you. But excluded, the following group can be legally excluded from the plan. So basically, if you have employees who are under 21 years of age, they can be excluded. Those that work less than 1,000 hours a year, they can be legally excluded because they will have to meet the criteria to qualify to join the plan of working 1,000 hours in a year. So if they work less than 1,000, then you're good. Union employees are excluded, and non-resident alien employees are also excluded. So let's talk about the benefits. Now, the first benefit is a high contribution limit of the solo 401k. That's huge. That is a huge. Now, when you have a business, think of it, and I'm showing here two hats because you're actually wearing two hats. You're wearing the hat of an employee and the employer. You're the business owner, but you're also doing the work. So as an employee, you can contribute up to $18,000 per year. It's called the elective deferral or salary deferral. And then if you're over 50 years of age, you've got additional $6,000 in a catch-up contribution that you can contribute. So the total limit is $24,000. Okay, now this contribution can be up to 100% of your self-employed earnings. So if you are, if you have a full-time job elsewhere, and if you have a side business, and let's say you only made $25,000, out of $25,000 you can shelter $18,000 into retirement account. You know, that's huge. And that can go into either a pre-tax or a post-tax Roth, because solo 401k has a Roth bucket, if you will, that you can contribute after taxes. We'll talk more about that. And then second part is the profit sharing contributions, and that's when the business makes the contribution. It's kind of like a matching with your employer, but there is no match with the solo 401k. It's called the profit sharing. So up to 25% of your self-employed compensation, 20% in case of a sole proprietorship or single member LLC. and that is can only go that's tax deductible. So this is a pre-tax, can only be made with the pre-tax dollars, and that's a dollar for dollar deduction for your business. Now, if you look at the combined limits, okay, the total limit, the sum of two is $53,000 per year. And if you're over 50 years of age, then you have the $6,000 catch up, which makes it $59,000. So think about this. Combine, if you're just a single business owner, you can put over $50,000 you can shelter from your income. And if you're husband and wife doing a business together, you can shelter up to potentially over $100,000. Think of a tax impact that it's going to be. Talk to your accountant about this, but why would you give money to Uncle Sam where you can rather put that into your retirement account, because the savings can be huge. Not only you're sheltering or minimizing your taxes, but actually it's kind of a double impact, because if you're able to shelter $50,000 or $100,000 from your income, that's probably going to set you in a different tax bracket, much lower tax bracket. So you're going to be paying lower percentage on lower amount. So the impact can be pretty significant. And again, this is very important to do, because here, another quote from Proverbs, it says, the wise man saves for the future, but the foolish man spends whatever he gets. So it's very important for you to do that, to have some sort of savings or retirement plan and put money away for the future, because you're young, maybe you're able to work now, and you as we get older, we're not getting any healthier, and so we need to have a plan. Now, next benefit of a solo 401k is a loan feature, and basically it's pretty cool feature that allows you to borrow from your retirement account, and the terms of the loan are typically 5 years. So you can take a loan from your retirement account for any reason, and you just have to pay it back over 5 years. The payments can be made monthly or quarterly, so those are amortized payments, and the interest rate is set at prime plus 1%, and that's currently 4.25%. So it's very low rate, and guess what? When you make the payments back, you actually pay an interest back to your own retirement accounts. So your retirement account is growing. It can be used for any reason or purpose whatsoever. You can access up to $50,000 or 50% of the account balance, whichever is less, without taxes and penalties. Okay, so think of it as that you basically creating your own bank that will never tune you down. Right? Won't it be nice to have something like that? When you go and apply for a loan, you have to qualify for it. Here, you're the one who approves it, because you're the administrator of your own plan, and you're the applicant or participant. So you approve your own loan. Again, as long as you follow the guidelines and set rules, you can access that at any time. Now, it's another one of the other ways it can be used for some kind of transaction that otherwise can be prohibited. There are certain things that are not allowed inside of a retirement account, but if you can pull the money, then you can use it however you wish, as long as you pay that back. And guess what? This feature is not available with a self-directed IRA, so it's only available with a solo 401k. So a nice feature to have. Let me give you an example of how useful can it be. I have a client who was referred to me by somebody. This lady, she had a medical debt of pretty high interest rate, and she was just paying interest, pretty much just only interest payments, and the balance wasn't really going down. So she was considering just pulling money out from her retirement account, just cashing in, taking early distribution. And when she met with her accountant, the accountant did run some numbers and said she needed about $10,000, and accountant told her you need to pull about $20,000 because after you pay taxes and penalties, you're going to be left with about $10,000. So close to 50% of the balance will be lost. Now that's very unwise financial decision to lose 50%. Now once we talked and I consulted with her, we set up a solo 401k for this lady, and then as soon as she did the rollover, she was able to take the loan out of $10,000, not 20, just 10. She paid the loan off of that high interest, and now she's paying it back to her own retirement account, and the $10,000 that she would have lost is now invested and working for her. So this is a great feature. Next benefit is the ability to make Roth contributions. Now the solo 401k plan allows you to make contributions on a pre-tax or tax-deferred basis as well as after-tax or post-tax basis into Roth sub-account. And guess what? There is no income restrictions for the Roth type of contributions. And if you compare that with a Roth IRA, there is a, I think, I forgot exactly the number, but if you make over a certain threshold, you're not allowed to make contributions into Roth. And you know, the limit on Roth contribution is $18,000, and if you're over 50, you've got additional $6,000 catch up. So up to $24,000 can go into Roth 401k each year for each spouse. Compare that with $5,500 plus $1,000 catch up with a Roth IRA. Huge difference. So all of the income and gains that generated by the investments inside of your Roth account are tax-free. Think about this. Is there anything else or any other vehicle that you know that can produce tax-free income? I don't think so. I'm not aware of one, because Uncle Sam wants to tax us on pretty much on all the income that we get. But if you do it inside of a Roth 401k, it's tax-free when you pull it out. Now the contributions that you make to your Roth 401k can actually be pulled out at any time. Many people are not aware of this. You can touch the earnings, but the contributions that you put into account, you can access that early. And you can also do Roth conversion. So if you do have some pre-tax retirement account, you can convert portion of that, pay the taxes on it, no penalties, just the taxes, and then continue to invest tax-free for the rest of your life. Next feature is it's very cost effective, and it gives you checkbook control over your retirement account. Once the plan is established, you as a trustee of the plan can go to any bank, credit union, or brokerage, and you can open up an account there. You do not need a custodian. You act as a trustee of your own plan, so you eliminate custodian fees forever. You eliminate any red tape and any delays that are associated with the custodian. By serving as a trustee of your own plan, you are in control. There is no one between you and your retirement dollars. You eliminate the middleman, so you can act quickly. If you have an investment, you can immediately write the check and execute the transaction. It's very easy to operate. There is only one requirement as far as the filing, annual filing, and that only applies when your plan balance exceeds $250,000. So that's the threshold. And in this case, there is a short form called 5500 EZ. It's only 2 pages. It's very easy to complete. You're required to file that annually if you're over that threshold. Otherwise, they're pretty simple to operate. Now, buying real estate is very common within self-directed retirement accounts. You need to understand that all of the income and gains generated by the investment are tax deferred, so you're not paying any taxes on the gains, and that's huge. You know, that's a power of tax deferral. I don't have a comparison here, but you know, if you're paying taxes every year in a taxable account, over the years the the difference can be huge. So you will pay taxes at a future date rather than in the years the investment produces the income. So again, the power of tax deferral. The income and gains generated in a Roth 401k are tax-free forever. Again, that's huge. Now keep in mind that all the income and all the gains from the investments must go back into the retirement account. So you cannot use it now, you can use it later. And all of the expenses must be paid from the account as well that are related to the investments. So make sure there is no commingling. One question that I often ask is, can I finance real estate inside of my retirement account, or do I have to come out with all cash? The truth is that you can finance your real estate purchase, but you're not allowed to provide personal guarantee. Therefore, the loan must be non-recourse. Non-recourse means that property is the only security for the loan. You cannot provide personal guarantee. Normally with conventional retirement account, when you go to the bank and apply for a loan, you sign the paperwork and you basically give authorization to the bank to come after you. If you were default on the loan and there is a deficiency, they can come after you personally. It's not allowed within a retirement account. So the lender, the only security for the lender is the property itself. Now, because of that, the risk to the lender is higher. So you will be required to put 30 to 50% down payment. Property must produce cash flow. You must have also enough cash reserves within your retirement account. About 10% of the purchase price is what the lender is looking for. And the income from the leveraged real estate will trigger UDFI, which is unrelated debt finance income tax, if you do it inside of an IRA, but not within a 401k. So there is no tax on this, it's exempt. And there is only a handful of banks that offer this type of financing that we work with. There is also private lenders that can provide non-recourse financing, but you'll end up paying more for that. So the benefit of the solo 401k that it is exempt from that unrelated debt finance income tax on leveraged real estate, and that tax is assessed at about 35%. So it is triggered by leveraged real estate inside of an IRA, but 401k is exempt from that rule. So it's very tax efficient solution for leveraged real estate inside of a retirement account. Another benefit is that you can combine multiple retirement accounts into one. So basically qualified rollovers or transfers from traditional IRA, SEP IRA, simple IRA, any type of employer-sponsored retirement accounts can be moved into solo 401k. Now here, let me make a note here, is that if you have a retirement account with the employer, such as 401k or 403b, if it's a current employer and you work in there, the chances are you're not going to be able to move them while you employ there. There are sometimes exemptions, so you can inquire about what's called the in-service distribution. Sometimes some employers do allow that while you're working there, and that's what in-service means. You are still in service, you're still working there, and they will allow you to move that, but the chances are you can't touch that while you're working there or until you reach retirement age. The Roth IRA is the only exception. The Roth IRA cannot be moved over into a solo 401k, so it's very important that you understand that. Now, and another benefit is that it gives you ability to achieve true diversification. And here's another cartoon that my daughter drew for us. Is this man and looking at the basket, and the eggs fell off and got broken, right? And the wife says, "I thought that our investments were diversified." Well, and that's what you may have currently within your retirement account. If you're just invested in equities, you don't have true diversification. but with a self-directed retirement account, you can achieve that. You can take some money, you can keep it in the stock market if you wish. You can take a portion, put it in real estate. You can take a portion, put it in trust deeds. You can take portion. You can buy metals if you'd like. Gold and silver just to shelter against inflation. You can invest in a business. The potential is virtually unlimited. And again, this is a wise thing to do. And again, I mentioned that what we teach is based on proven biblical principles. So Ecclesiastes 11:2 says, divide your portion to 7 or even to 8, for you do not know what misfortune may occur on the earth. We don't know what's going to happen with the stock market tomorrow. We don't know what might happen with other investments. So it's just a wise thing to do to diversify, to spread your investments across different asset classes. Now let's talk about a few things that you cannot do inside of a retirement account. So when it comes to a solo 401k, there's only 2 things that you cannot invest in. Number 1 is collectibles, and that can be coins, stamps, artwork. Anything that is considered collectible is not allowed to be invested. And also S Corp, because subchapter S Corp requires physical person to be a shareholder. You can invest in the C Corp but not S Corp. And that is defined in the Internal Revenue Code section 4975. Clearly explained that. And on top of that, the same section explains that there is a certain persons that are considered to be disqualified. Disqualified persons are not allowed to be engaged in any transaction within a retirement account. So the disqualified person is the participant of the plan and his or her spouse, any ancestors and lineal descendants, and their spouses, any entities in which disqualified person holds a controlled entity or management interest. Okay, we'll go over some examples on the next slide. An exemption to that can be a brother or sister. Brother or sister is not considered to be an immediate family member, or cousin, or aunt, or uncle, friend. So basically, to make it easy for you to remember, think of it as a vertical line. So the vertical is a no-no. Your parents and grandparents, your children and grandchildren and their spouses is no. But horizontal, you can go sideways. And that's what the brother and sister and cousin and uncle are okay. So what are the prohibited transactions? The same section explains what is it that you cannot do. So basically, doing any sale, exchange, or leasing of any property between a plan and a disqualified person. Lending of money or other extension of credit between a plan and disqualified person. Remember we talked about non-recourse financing, because you're not allowed to provide personal guarantee. Providing any goods, services, or facilities between a plan and disqualified person. And that's, an example here will be if you buy a property within your retirement account, if you're a real estate agent, you can't act as a realtor on that particular transaction. Transfer to or used by or for the benefit of a disqualified person of the income or assets of the plan. In other words, you can't personally benefit. Your plan, your retirement account must benefit from all the investments. Act by a disqualified person who is a fiduciary, where he deals with the income or assets of the plan in his or her own interest. So basically, when you invest in retirement dollars, it must be, you cannot get any benefits from that. So it has to be arm's length transaction. And receiving any consideration for your own personal account by any disqualified person who is a fiduciary from any party dealing with the plan in connection with a transaction involving the income or assets of the plan. Again, all the transactions must be arm's length. Now let's look at some of the most common prohibited transactions. Engaging in a transaction directly or indirectly with disqualified person. Sometimes the question, not here I underline indirectly, and let me explain that. A question that I sometimes get asked is that sometimes somebody sets up the retirement account and say, well, I am a disqualified person, so I cannot sell my property to my retirement account. But can I sell it to my brother, who is not a disqualified person, and then after some time my brother sells it to my retirement account? Well, the question is, the answer is going to be no, because that will be indirect prohibited transaction. If it is a prohibited in the first place, don't look for a way out. Purchase property from a disqualified person using 401k plans as a security for a loan. So you cannot pledge your 401k assets as a security for a loan. Guaranteeing a loan for your 401k plan, that's why you need to use a non-recourse financing. Loans between the 401k plan and disqualified person. Well, you can take a participant loan from the 401k, but you cannot, if let's say your father wants to buy a property, you can't lend the money from your 401k for him to buy the property. If it was an unrelated person, then you can, but not in the case of a disqualified person. Also, investment in a business in which plan participant or other disqualified person already has 50% or more interest or ownership. That becomes a prohibited transaction. And then receiving any consideration for your own personal account in connection with a transaction involving the income or assets of the plan. Being compensated for any services performed for or on behalf of the solo 401k plan. I give you an example of being a realtor. Cannot do that. And then commingling of funds between the plan and your personal account is not allowed. So again, there is so many things that you can invest in. You just need to understand what are the things that are prohibited and just stay away from that. Don't look for a way out. So the process of setting up the plan is quite simple. The step number one, your business adopts the plan. Step number two, your plan and trust is created. The plan will have a trust attached to it, and trust is going to be the vehicle that will hold assets of the plan. Step number three, funding of the solo 401k, and that's when you transfer funds from your existing retirement accounts, or you can make a contribution. And the good thing is that unlike an IRA, where the limit is pretty small, about $5,000–$6,000, with a 401k, if you're self-employed and you're generating good income, you can potentially put $50K into a year, or even more if you have a spouse. And then once the plan is funded, now you as a trustee of the plan have a checkbook control to make the investments. And the investment can be made as simple as just writing a check. So again, if you're thinking that way, if you only invested in the stock market, and just as this cartoon says, just going down and thinking that it reminds you of a stock market, maybe it's a time for a change. So think about this. But that concludes my presentation today. I just want to mention that everyone on the call is entitled for a free consultation. You can actually schedule that by going directly to this link, SenseFinancial.com/free-consultation. And here you can have access to my calendar. You can pick time that is available or works best for you. You can block that. It goes directly on my calendar, and we'll have time to chat about your particular situation, so I can learn more about your situation and answer your questions, and then make recommendation that is best for you. And again, here's my contact info. You're very welcome. Feel free to just jot it down and If you have questions now or perhaps in the future, you're welcome to reach out to me.